In a world filled with information, where do you turn to get straight talk about retirement, investments, and your money? Lock it in to the longest-running financial talk show in Arkansas, and let us help you build the bridge between information and application. Real financial change begins right here, and it starts with you.
It's showtime! Woo!
You've heard the saying, what you don't know can't hurt you. But in your finances, what you don't know about money can hurt you. On today's show, 5 blind spots that could wreck your retirement.
This is the Get Ready for the Future show.
And all across the state of Arkansas and live streaming on Facebook, welcome in to the Get Ready for the Future show. My name is Scott Inman, feeling a little bit like Max Headroom, at least if you're watching on TV. I am face in a box behind John Shrewsbury and Janet Walker. Glad to be back, by the way. It's been about 3 weeks or so.
Yeah, we're glad
and if
to
you're
have
old
you.
enough to know who Max Headroom is, then you're
This is
probably
the show
on
for
the
you.
right show.
Yeah.
Exactly.
That was what, 80s? We're
Yeah,
going
it
way
was
back to the
80s.
80s
Yeah,
on
it
that. But
It was.
It was a Coke commercial, wasn't it? If I
believe it
remember
was
right.
Pepsi.
Pepsi, okay. See,
Yeah.
So.
advertising doesn't last 40 years.
Yeah.
I've forgotten.
It was a soft drink.
And then he was a music video.
Yes.
Yeah, that's right. But he was basically a person, but it was in the computer or on
Digital
the TV.
form.
Like MTV-esque.
Yes.
You know.
Yes.
Yeah.
So that's where we are. But I am glad to be back. It's been a few weeks. I was out for family reasons. Want to thank you for all filling in. I know our team of advisors is strong, and they rotated in and out. And, John, you took over. You were Max Headroom for a couple of weeks. So we appreciate you doing that for
My
sure.
wife still says I'm Max Headroom. So, Janet says I'm Max Headroom because my head's so big. And
There we go.
She would say
so
that.
moving right along.
Yes.
We got a big
Anyway.
show today. We got to get right to
do.
it, right?
Yeah,
So
we do.
We're talking about what you don't know about money can hurt you. We've got 5 blind spots that can hurt you if you ignore them when it comes to your financial future. You know, we mentioned there in the open the saying, what you don't know can't hurt you. Another way of phrasing that is ignorance is bliss. I've heard that many times in my life. And guys, if it doesn't directly affect you, it could possibly be true, right? If it's some information that if you knew didn't really matter into your life, I guess ignorance could be bliss. But when it's your money, it's your financial future, it is going to happen to you, and if you don't know everything you need to know, or at least be aware of these blind spots and do something about it, it could wreck your retirement.
You know, the challenge on ignorance being bliss with your money is ultimately you learn, whatever it was you were ignorant about, you learn it many years later and go, man, I wish I'd known that. That's why it's not bliss, is that you realize that the reality of what you're having to deal with due to your previous ignorance is really not good.
And Scott, I think that there are things out there that are not in your camp, so to speak.
Yeah.
And really don't have, they may be a wildfire, but it's not affecting your camp. But there are things that are in your camp. If you don't know those things, then they can be detrimental to you. And we've seen that over and over again in dealing with people's finances, particularly their retirement. Some of the things that they think that they should be bliss about, that they should be ignorant about, that they just, kind of whistle in the dark and just keep right on going. Those are eventually the things that will come back to haunt them.
Well, in our show today, in most of our shows, this is our goal, is to provide you education on what those things are, and then to give you some action points on what to do about it. So 5 blind spots today. And later in the show, in fact, in our next segment, we've also got Burt White on, LPL's Chief Investment Officer. He was with us on our last webinar earlier in the summer, and Burt's going to talk about a lot of things when it comes to investing. What are the blind spots there? And he's got a really cool story that he's told on stage probably multiple times. I've only seen him tell it once, but it's actually on YouTube, I think, too. So if you want to go back and hear it again after he tells it today, but it's about an anaconda attack and how to survive one. It was a very cool story.
Yeah.
A lot of fun to hear him tell it, so he'll be on to tell us about that.
And Scott, that is really apropos for our deal here today, our theme today, because you may be going, well, why do I care about an anaconda attack? There's no anacondas in Arkansas.
Well, it is 2020.
Yes.
Well, that's right. We've already had the murder hornet, so,
Yeah. That's very true.
Yeah.
So,
But it does relate to your money.
it does relate to your money, and it is very apropos to what we are dealing with here as we head into an election, lots of volatility in the market and things of that nature.
All right, so let's dive in and do number one. We've got 5 blind spots to get to, and we're going to have to pause for Burt White in the next segment. So we've got about 4 minutes here before we take our first break to focus on number one. And number one on our list of 5 blind spots is focusing on the small things while ignoring the big ones. You know, you think of we applied the saying, what you don't know can't hurt you. There's a great saying that attaches to this. You can't see the forest for the trees, right? I mean, you're in the middle of it. You're in the thicket. You can't have the perspective of zooming out and seeing everything that could happen.
Scott, I oftentimes have this conversation with clients, and I talk to them about understanding outcomes. That's really the big picture. What is it that you're wanting to have from your retirement? Because you could have the greatest portfolio in the world that had the greatest rate of return and the smallest fees and all of the little things that people tend to focus on because the media tells them those things are important. And those things are important, but they're not the most important thing. And the most important thing is getting the outcome of your retirement plan that you're looking for. I was just visiting with a couple this morning and talking about their retirement. And I said, look, I think what I'm hearing you say is you want to be sure that the income that you have now continues to come in retirement so you can go live your life and you can have the income and it lasts the rest of your life. And they all nodded their head. Yes, that's exactly it. We had zero conversation, Janet, about rate of return or fees or anything of that nature. We will have those conversations, but we are not going to focus on that in terms of their overall financial plan because it doesn't necessarily predict the outcome.
So another point on focusing on the small things while ignoring the big ones. The small things in this category could be 1,000 different points. Pick what one applies to you. But ignoring the big one, we talked about this on last week's show. We talked about people ignoring the company match. So if you have a retirement plan at work, that can add up to a significant amount of money over time. And if you ignore that by not contributing enough to max out the match, then you are really ignoring a big factor in your retirement preparation.
Yeah, and I think oftentimes people think about the company match as relative to the percentage.
Yeah.
Well, they only match 3% of my salary. Well, that's 100% match on 3%. And we saw last week what that 3% would do. It makes $500,000 difference in certain scenarios.
Yeah, it's a game changer.
In your retirement plan, and to ignore that is foolhardy.
Absolutely.
You know, I think about when you phrase it as small things, focusing on small things but ignoring the big ones, those things get transversed in someone's life because the small things are happening to you right now, typically, right?
Yeah.
Right. The big things are so far away in the future. I'm 47 years old, and I think about people in my stage of life. You still got kids in the house. I've got 3, about to be down to 1, by the way, in less than 12 months. Don't know if I like that or not, but anyway. But it's pre-empty nest, right? You're thinking about just getting the kids through their education. Maybe it's even college education for the kids, which we don't discourage saving for, but at the expense of you saving for your retirement. That could be a problem. That could be focusing on a small thing, even though it's not really that small for the child to get an education. But if your future depends on you putting back a certain amount to reach your retirement goals, and you choose instead to fund a college fund or buy a kid a new car, let's put it in that phraseology, that's difficult. That's a difficult decision to make, and it could be a problem for your retirement.
Hey, let's face it, the tyranny of the urgent can dominate you as far as your finances are concerned. The thing that is burning right now, the thing that is, that little yapping dog, if you will, in your ear right now, can turn your attention from that big picture. And that's why we talk about having the mindset of an investor. And having the mindset of an investor means that you're going to invest money regardless of whatever else may be going on in your world. You're going to continue to save for your retirement because, hey, look, there are no do-overs in retirement at all.
I think when we talk about the tyranny of the urgent, if you want to compare urgent to important, and we do this in business to prioritize our actions, your retirement has to be important. There are things that seem urgent right now that may, when you really look at them, just be emotionally urgent, not financially urgent. Be sure you're paying attention to the decisions you're making.
It is called a blind spot because you likely can't see it. And you have one, you just may not know it. And we can help you find your blind spot. You can call us today at any time to talk about your financial plan, and we will build one. It's the Gen Wealth Ready to Retire process. We'll talk about how you can get that at a discount. When we come back, we're also going to have Burt White on right after this.
At Gen Wealth, one of our standards is we believe in balance, and it's really a twofold standard. For our team, we believe that you've got to work and you've got to do things the right way, but you also have to have some time off, and you can't do your job if your job is all you do. For our clients, we believe in balance because their investment portfolios need to take as much risk as they need to achieve their goals, but not so much risk that they lose everything that they've got. Balance is incredibly important in both our team and for our clients.
There's always been power in standing up for what you believe in, challenging the status quo, and never accepting the ordinary. What about the rest of your life? Will you settle? Or will your retirement be more? More fun, more family than finances, more than just investments. Connect with us at GenWealth and harness the power of more.
You ain't heard nothing yet. Buckle up, because we're back with the Get Ready for the Future show.
Talking about 5 blind spots that if you ignore them, they could wreck your retirement on today's Get Ready for the Future show. Right before the break, we didn't have time to fully tell you about your opportunity to help or let us help you find your blind spot. You can give us a call for half off of your financial plan if you call today, 501-653-7355, and make an appointment with a GenWealth advisor. We've got offices all over the state of Arkansas, in Conway, Hot Springs, Bryant, West Little Rock, El Dorado, and also in Northwest Louisiana. So that one number will get you connected with an advisor, 501-653-7355. And today only, our offer for calling and getting a financial plan for half off our usual cost. We are pleased to be joined by LPL's Chief Investment Officer, Burt White. Burt is joining us via Skype today on the Get Ready for the Future show. Welcome in. He's got his smile on. He's ready to go.
You almost gave me a promotion there, which
did.
I really appreciate.
I did. I'm pushing for you. Just ask him to call me. I'll do whatever I can do.
So,
hey, we talked a little bit in the first segment when we mentioned we were going to have you on today, Burt, that you had a great story to tell. And I've heard it from when you told it on stage at Focus. I know it's probably not the only time you've told it, about how to survive an anaconda attack. So our jumping off point today is story time with Uncle Burt. Tell us how to survive an anaconda attack, and what does that have to do, please, with your money?
Lord knows. I mean, seriously. No, it's interesting as I've been listening to the show. I know that you guys are talking a lot about sort of these pitfalls, right? These things that you don't see coming, these blind spots. And I actually think this story is perfect to talk about those, right? And that's because sometimes the obvious thing to do isn't the right thing to do. And sometimes the thing that just feels natural to do isn't the right thing to do. And this story basically is a highlight of that. So the backstory of it is that when I graduated high school, I got all these gifts, and you wanted the ones that were in an envelope because it had money. But the neighbor gave me a book, of all things. You give a high school senior a book. But it was a Peace Corps manual, because this was his man's guide to life, right? He didn't go to college. He went to the Peace Corps. And over the years, it's become really personal to me. It's almost like my blanket. And so, but on page 142 is my favorite story. Now, understand that the Peace Corps manuals, it's kind of like a Boy Scout manual, right? It's like It's got stuff like how to build an igloo and, how to get water out of a cactus and how to rub sticks together to make a fire and stuff like that, right? And so, but on page 142, it's how to survive an attack from an anaconda. Now, I thought I knew how to survive an attack from an anaconda, and that is to run. Right? So
run. Yes.
You're right. But what it tells us is sometimes the right thing to do isn't the obvious thing to do. And I think that's what you guys are all talking about today on the show, is that sometimes you got to be thankful. You got to be thinking about things that really maybe aren't as obvious, right? That you just need to think about. And so here's how the story goes. Imagine that you've been working all day doing God's work, and you just can't wait to get back to your tent for a little bit of pork and beans by the fire. You're 100 feet from your tent, and out of the tree drops a 38-foot, 750-pound anaconda.
Done.
Do you do? Okay, so if you don't faint, what most people say is they run, but that's the wrong answer, right? Here is what it is. Now, I'm reading this to you because it's so ridiculous. It's also kind of funny, but it's ridiculous. But it's the right way to do it. And then what we'll do is we'll pull it back, and it has a great moral to it, a great lesson to it. So here's how just word for word. The first line of the manual says, if attacked by an anaconda, do not run. The anaconda is faster than you. That's true. It can move at 6 miles an hour through the bush. You cannot. So if you try to run as an ambush predator, it will track you down, wrap you up, and swallow you whole. That is a bad result. So don't do that. So what do you do? Here's what it says, word for word. Quote, lie flat on the ground. Do not panic. The anaconda will begin to climb all over your body. Be calm. Now, who had that idea? Like, just show of hands. Who thought, like, maybe I'll lay down and let the snake crawl over me, right? Oh. Now, what's weird about this is it not just tells you what to do, but how to feel, right? Don't panic, be calm. And that's largely because this is weird. Okay, it gets worse. After the anaconda, this is a quote from the manual, after the anaconda has examined you, it will begin to swallow you, beginning with your feet. Be calm. Now, there's a big assumption here. The assumption is that it starts with your feet and not your head, right? Yeah. So what's the deal with that? Well, most of us, our ankles are thinner than our shoulders, and snakes like us want an appetizer, and so it wants to start with the smaller piece and work its way up to sort of the main course, right? And so it starts with your feet. Okay, here's the next one. Is a quote, when the anaconda is almost fully, skip the line. The anaconda will suck your feet into its body. Be still. I love that line. This will take a long time. Listen, my friend, do you think swallowing you whole is easy? No. Listen, stop wiggling. Be still. Think of your happy place. Read a book. Take a nap. Whatever, right? But just be still. It will go a lot faster if you just be still. Quote, when the anaconda has almost fully swallowed your legs, calmly remove your knife and kill the snake. After all, your legs are crammed down its throat. What can it do? You just reach down, grab your knife, kill the snake, cut it off, wiggle the snake down like a skirt, and then walk to camp. But the last line is classic. It's classic. The last line is, be sure to have your knife. Because if you don't have the knife, well, you're pretty much going to get swallowed. And so the point of the story is, it's 2 points. Number one is, you'd never think of that. like you'd never think of that. And the key is you have to have a plan before the snakes show up. You see, once the snakes show up, and then you're like, oh, I need a plan, you're probably not going to do very well, right? You're going to have emotion. You're going to react. It's too late. The key is you got to know what to do before the snakes show up. And here is, in the world of sort of finance, in the world of the markets, you guys know this better than me, there's snakes out there all the time. Like, it's always out there, right? And so you got to have a plan, knowing that you got to know how to react to whatever's going to be thrown at you. And just this year is unlike any other. You know, the world's longest expansion we've ever had in the United States, a really good economy, comes to a screeching halt overnight. Hit a tree. You know, just literally our economy hit a tree. And that's how fast it can come. The question is, do you have a plan? And if you don't, well, then, you know, you're going to be in trouble. And that's really the story of the anaconda.
So where are we with the anaconda attack right now? Because a lot of people think they see an anaconda coming because of the election and the COVID thing and all of that. Where are we right now in the opinion of the chief investment officer?
Yeah, well, I kind of like the other title better, to be honest, but I'll stay with that one. That's my real one. No. So, I guess here's how I'd answer that. So I'll answer it two ways. I'll actually answer it, the second part of my answer, maybe. But the first part is the key of this is, look, there's always things to be worried about in the market, right? I mean, there's always things in the market. And that's why you always have to have a plan. It's always why you have to have a well-diversified portfolio. It's why you've got to make sure you understand what you're trying to achieve. And it's why you got to have an advisor to help you do that. And so that's the most important thing. That's what the story tells. But as it relates to sort of where we are in this, we continue to believe that the economy is continuing to come back. We've seen a big move higher, back in economic growth. We've recovered about half of what we lost in the earlier parts of the year with the pandemic. The easiest part has been done, however, right? And so I think the tougher yards are yet to come. I think the most important thing to think about when oftentimes when people ask me, what is the shape of the recovery? And there's all these letters, it's a U shape, a V shape, an L shape, a Y, a square root, and there's all kinds of stuff that people describe kind of what that looks like. What I've always said is I always believe that regardless of downturns, there's always a K-shaped recovery. And here's what I mean by that. When you think about the shape of a K, it goes down and then it kind of comes up and then it splits up and down, right? And so the reality is what happens, what I mean by a K-shaped recovery is that during tough times like recessions or like we saw earlier in the year, everything goes down and everything did go down, right? But then most things come up as well, at least part of the way. But then what happens is it bifurcates, and you have things that are going to win and things that aren't. Because what a lot of people miss is that half of the stocks in the S&P 500 were created during turbulent times. And that's only about 10% of the market time, and yet it creates 50% of the names. And why is that? It's because when turbulence comes, that's when real problems happen. And that's when companies that win solve real problems, and those that lose miss the opportunity. And we just through a period of time where, automation, teleconferencing like this, AI, data, technology, all that stuff is going to be heightened. And so those companies that are going to be on the cutting edge of that, I think are going to continue to be the upward part of the K and be moving higher. I think those companies that aren't going to make that adjustment are going to struggle more. And I think this is natural in any of these pullbacks. And so the reality is that as I see this, I think our economic growth continues to move higher. I think that businesses are hanging in there pretty well, at least larger companies. Smaller companies and Main Street companies are beginning to come back online. It is still really tough. Consumers trying to do the best they can, but being very reticent. And then it all comes down to employment. While a bunch of jobs have come back, we still have an extraordinary amount of Americans that are still struggling. And we've got a long way to go. And so I think, long story short, I think we are in an upward trajectory. The easy yards have been played out, and I think from here forward, it's going to be incrementally higher.
Burt, last time we saw you, you were in your house. We see that you're back at the headquarters at LPL, and you've gotten out of the house. We're proud of you for venturing out.
Thank you.
I understand that was really by necessity.
Yeah. Well, listen, I thought I had a great office until I actually had to work in it. And then I realized that I don't have a good home office. And so I was driving my family completely insane. And so I didn't actually come into this, into my actual office because I wanted to. I came in because I was kicked out of my house. And so that's
excellent. Hey,
Burt's homeless.
Hey guys, if we could, can we hold Burt over just a little bit? We've got a commercial break coming up here in just a few seconds, Burt. But would you hang with us? We had a few more questions for you. You have time?
Happy to.
Okay,
great.
That's what we'll do. We'll take a pause, take a break on the Get Ready for the Future show, and be back with LPL's Chief Investment Officer, Burt White, right after this. Stay with us.
At Gen Wealth, one of our standards is that we value good communication. One of my favorite quotes about good communication is from George Bernard Shaw. He said, "The single biggest problem in communication is the illusion that it has taken place. If you ever doubt that, come to my house, listen to my 16-year-old son and my 13-year-old daughter having a conversation and see what happens, because they will walk away with completely different understandings of the conversation that has occurred. It happens every time. It's okay. They're still learning communication. But here at Gen Wealth, we believe that that's something you need to experience every time you walk in our door, that you need to feel understood, that you need to feel listened to. So you'll see a change in how we're even communicating. If you're talking about something that's very serious, very personal, you'll even hear a change in our tone of voice, because that's just how good communication is supposed to be. But it also means that we can feed back to you what you've shared with us, just so you know that we're listening. We value good communication.
Back with more straight talk about retirement, investments, and your money on the Get Ready for the Future show.
Our topic today, 5 blind spots that can hurt you if you ignore them. They could even wreck your retirement. We've talked about one, and we're going to get to the others, but we want to continue our conversation right now with LPL's Chief Investment Officer, Burt White. And Janet, we kind of have a blind spot question for Burt.
Yeah, we do. So, Burt, on the show today, as Scott mentioned, we're focusing on blind spots for personal finances. So when it comes to investing, what's your parallel? So the anaconda obviously would be a blind spot if that happens to you in real life. But when it comes to investing, what are the blind spots that we need to be aware of?
Wow, there's so many. Gosh, and I wish I knew the 5. I can't wait to hear the rest of the rest of the 4.
Stay with us through the show.
But I would say this. One of the things that when I get asked this question, I usually say this. I can't tell you, because I get to go around and talk to so many people, and it's such a joy. And everyone asks me the same questions. Oh my gosh, Russia's really bad, and China's bad. And trade is bad, and all these other things, all these geopolitical risks is bad, and if Democrats win, it's bad. If Republicans win, it's bad. And all these things are the bad guys. Let me tell you who the real bad guys are. In my opinion, you have 2 really bad guys: taxes and inflation. And we miss them. Like, we miss how important they are. Look, the reality is taxes take between a third and a half. Like, I don't know how bad China and Russia and Democrats or Republicans are going to be. I just know they're not going to take half. That's what I know. They might be bad, but they ain't that bad. And then the other piece is what's left. Inflation takes 3 or 4% of it. Okay. And so, like, if you're thinking about making 10% from equities over the long haul, and you have to give a third of that back, and they have to give 3% to inflation, like, those are the bad people. And so to think about a strategy that helps to understand it, to help mitigate it, to overcome it, I think those are the things. And so one of the big things for me is we've got the wrong bad people. Like, we're chasing the wrong criminals. And I think in our personal finance, we got to chase the right criminals and not chase all these other things. And we got to start chasing the things that really could affect us from hitting our goals and dreams.
John, you want to take that final question for Burt?
Burt, do you fear in this day and time that investors are going to get blindsided by not the stock market, but maybe the bond market? Maybe the interest rate issue is something that people don't see coming. And we've talked about this before, but I'd love your thoughts on it right now.
Yeah, I think it's not many people are talking about it, and I think it's great that you all are highlighting this. I think this is one of these things that sits below the surface that's going to end up biting people if they're not careful and they're not planning for it. What a lot of people don't realize is that interest rates are so low right now, like the yield curve and the interest rate environment is so low right now, that if rates doubled, if they went up 100% to end the year, between now and the end of the year, if they completely doubled, 100% growth, we'd still be at the lowest end of year yields of all time. Okay, so it just goes and tells you how far low we are. The real question is, what's the direction? Here's what we know. What we know is that inflation follows growth. That's what we know, right? So if growth is fire, inflation ends up to be the smoke. And the reality is it follows it. And if you think, I believe that we're going to have, we're already starting to see growth. And you're going to start to see growth, in my opinion, in our economy through the rest of the second half and into 2021. Regardless who the president is, I think you're going to see economic growth in 2021. And that means inflation follows. Now, we haven't had an inflationary environment for a long time. But understand, we also haven't had record low interest rates at zero. And so rates will be moving higher. That is a fact. There's no direction for it to go anywhere other than either stay where it is or move higher. It can't go lower. Like, it just can't go lower. The Fed is scared to death to raise rates because they got a little bit ahead of you probably did a little bit too much in the last cycle and they got burned. They touched the stove and they got burned. But I believe, and because of that, I think inflation might sneak up on people, including the Fed. And if that actually happens, now, first of all, that's not a terrible thing because that means that we will have had some growth, and growth means we will have a good recovery. That said, we know that inflation ends up to be a big impact for older Americans. If you actually look at the inflation rate by age, you have actually negative inflation or deflation for younger folks, right? Because they're buying things like technology and things like that, where you're getting more stuff for cheaper every day. But man, if you're over the age of 65, or if you're my age in your 50s, your inflation rate's a lot higher because you're paying for things like healthcare and education and a bunch of those things where the inflation rate's a lot more than that. And as this country ages, we're going to start to see more increase in its the impact on inflation. So long story short, John, I just believe that inflation could end up coming back and snapping people a little bit by surprise. And if that happens, that could be a real negative emphasis on fixed income. And so therefore, you got to be really careful about how you're thinking about building your portfolio. Bonds are important as risk control. We know that. It's very important for income and very important for diversification. That said, how you invest those matter. And to really think about how you begin to think about investing those are going to be crucial. It's why you got to have an advisor. These are periods of time where the obvious things to do are not the right things to do. And so to make sure that you really begin to think about how to craft that and survive the next anaconda attack, which really might be inflation.
Well, Burt, it's almost like you listened in on our show prep because you led us right into number 2. After we let you go, ignoring inflation is our second blind spot. So you've identified it for us perfectly. We appreciate that very much.
Excellent. Wow.
Yeah.
Hey, that's great. Maybe you can invite me back again. I can foreshadow 3, 4, and 5. Anytime. I know it's almost lunchtime for you. It's past lunchtime for you, so we're going to let you go. Burt, thanks so much for joining us today.
Burt.
Thanks, Burt.
Appreciate it. Thank you very much.
That's Burt White, LPL's Chief Investment Officer, with us on the Get Ready for the Future show, leading us into blind spot number 2, guys. And ignoring inflation is big. We deal with it, and it can really impact you in different ways depending on where you are in your financial journey. It can be impactful in your pre-retirement years. It can be impactful in your retirement years themselves. I think it really comes down to a lot of different ways you look at it. A lot of people want to keep their money in a what they would say, quote unquote, safe place because of the volatility in the market, maybe fearing that anaconda attack. But is it really safe when you are not keeping up with inflation? And then when it comes to taking money out as retirement income, Janet, that is huge as well.
Yeah, it absolutely is. This is an example we kind of wanted to walk through with. There is a rule of thumb, and we call it, John, a rule of dumb in the industry about a 4% withdrawal rate. And so when you start talking about inflation and also, frankly, volatility, that's part of this story as well. When you start talking about inflation, you've really got to think about the impact that it might have on your retirement income. So as we go through this, this is awkward for a left-handed person. I didn't think about that ahead of time. So if you have $1 million and as that money is invested, you go, okay, I'm going to withdraw 4% from this. So your 4% on this is $40,000. So you take out $40,000 a year and everything's good. Life is great, right? But how's the market doing? Is it always just fine and you can take out $40,000 and you have $1 million? Or does the market, maybe fluctuate some and not always in a positive direction? So when you have this happen in, let's say, a 2008, where the market was down 40%, Well, at that point, now you no longer have $1 million. You have $600,000. So how's that 4% rule going to work for you now? If you're now taking, 4% of 600,000, then it's 24,000. And when we're talking about inflation, you've not been able to give yourself a raise. In fact, you've taken a decrease in income. The other part of the 4% rule, instead of taking 24,000, if you say that you're going to continue to take this 40,000, well, that's no longer 4% of 600,000. It's now 6.7%. And so you're outpacing the growth. So the challenge here, John, for an investor is that, yes, inflation is real. I mean, Burt White just talked about this without even knowing that this is where we were going next,
right.
That this is, it's your next anaconda, frankly, that you don't know it's there. It's a blind spot for you. It is going to happen. And we've talked in the past about inflation is a sneaky enemy. There are lots of things that you see very openly. This one's sneaky. You have to just cognitively know that it's there and then plan for you to intentionally have an increase in your income throughout retirement. If you were to go to an employer, you're starting work in your 20s, and that employer said, hey, you can work here for the next 30 years. You're going to love the place. It's great. By the way, your income today is going to be the same as when you retire in 35 years. Would you take the job? There's no way that you would do that, right? We have to intentionally plan for inflation to give you, you've got to have an increase in your own personal retirement to address inflation in the costs of retirement.
And here's the real danger, Scott. If you have intentions of retiring or you're already retired and you don't have a plan on paper, on purpose, that really does give you the ability to increase your income as time goes on, then you are totally ignoring inflation. You may be giving lip service to it, and yeah, we got to deal with that. But if you don't have a plan to deal with it, then you're going to run into a problem, because people who retire, particularly like, let's say, on pensions, one of the biggest downfalls of a pension, unless it's inflation adjusted, is the same check that you get today is the same check you're going to get 10 years from now or 15 years from now or 20 years from now. Most private pensions are not inflation adjusted. And if you don't have a pension, then you've got to think about, how is it that I'm going to increase my income 5 years down the road, 10 years down the road, to keep pace with those rising costs. And we've got a great opportunity for people to actually come in and discover that blind spot and deal with it with our special, Scott, that we're running on the financial planning fee.
Yeah, we mentioned this earlier in the broadcast. Didn't give it too much color because we were kind of tight on time, but we do have an opportunity for you to call today during this show. And if you're listening to the radio broadcast on the weekend and you don't get an answer, just leave your name on the voicemail and say, I want to get the half-off financial plan. If you call us today at 501-653-7355, reach out to us and say, I want to get my financial plan for half off, like they were talking about on the Get Ready for the Future show. We'll get it done. We'll put you on the calendar. You'll meet with the Gen Wealth financial advisor. That first appointment is absolutely free of charge, though. You can get a complimentary appointment to see if you want to proceed, but the financial planning fee that is a value of between $500 and $1,500 will be half off for you if you call today. And it is a plan that takes precedent over an arbitrary withdrawal rule like the 4% rule that Janet just debunked. All right, so that is blind spot number 2. We're on to number 3, and we're going to have to hustle because there are 3 more coming up in our final segment next.
The beauty of a potter's work is that each item is unique. No piece is the same. That's what makes it art. At Gen Wealth, we believe your financial plan should be unique to you. Through our process, your money is carefully shaped around your goals and dreams. Your future, artfully crafted. Call us today or visit our website and connect with us. Gen Wealth Financial Advisors.
I don't think it's any coincidence that the Bible says, fear not, 365 times. one for every day of the year. At Gen Wealth, one of our standards is that we do not fear. We don't fear market downturns because we know that they're going to happen. We just simply plan for those things to happen and work around them. It's one of the things that we believe very earnestly, that you should never fear what you don't understand. You simply find a way to understand it and find a way to use it to your advantage. It's one of the Gen Wealth standards.
Want more straight talk about retirement, investments, and your money? Listen to our podcast on iTunes, Stitcher, or wherever you listen to podcasts. Now back to the Get Ready for the Future show.
5 blind spots that could wreck your retirement. That's the topic of today's Get Ready for the Future show. Welcome back. Scott Inman along with Janet Walker and John Shrewsbury. Our thanks again, by the way, to Burt White from LPL Financial for joining us today and making time to be on our broadcast. If you missed his interview, you'll at least want to tune in for the anaconda attack story. You can look that up on podcast through Apple's iTunes store or on Stitcher. You can check out our podcast. This broadcast will be up on that very soon. So we're up to number 3. We talked about focusing on the small things while ignoring the big ones as blind spot number 1. Number 2 was ignoring inflation. And number 3 on our list is the gap between perceived spending and actual spending. And this is really, if you're going to work towards financial independence, you need to live below your means and invest for your future in your pre-retirement years. But often we're not aware of how much we're actually spending.
You know, guys, I think the most common question that we ask that gets a blank stare in response is, how much money do you need per month in your retirement?
Yes.
And they could be 2 weeks out from retirement
or
they could be 20 years out from retirement, and the stare is equally blank. It's not time period relevant. So I think, and we've talked about this a lot over the years, you know, there was a time period when you got a paper check and you went to the bank and you deposited that, and you had to know exactly how much it was because you had to fill out a deposit slip. And then you wrote checks on whatever money you spent, so you were seeing those dollars and physically writing them out. And so you had if you kept your checkbook register along with that, then you had a concept of money in, money out. These days, with everything being electronic, and my gosh, you can go so many places and just pay with your phone. Not only are you not using a check, you're not even using a debit card in many cases. And so the psychological impact of not seeing money leave means really a lot of people have no idea how much money they're spending. And so I think it's important for you to look at that. And it doesn't matter to us what the number is. We're not judgmental about it, but we have to be able to plan for it. So be aware of what you're actually spending. And, whether it's $2,000 a month or $20,000 a month, I don't care, but you got to know what your number is so that we can help you plan.
Janet, we've got a cash flow tool on our website. You can download this. If you go to getreadyforthefuture.com/cash flow, all one word, cash flow, you can put your name and email address in there and download the tool that does help retirees get a handle on what their finances need to look like in retirement. How much are you really spending? A lot of people are surprised by that. One of the things they're surprised by are those annual bills that come around that they have to pay, like property taxes, car insurance, things of that nature. It may not be built into your monthly budget, but you have some reserve kicked back somewhere to take care of that. And if you're not careful, those things will surprise you. They will be a blind spot in retirement.
Here is a statement that runs counterculture. Retirement is not an asset problem. It is an income problem. And that's where you really need to define what your required income and desired income needs will be, and then the assets will be built into an investment strategy to provide that to you. So be sure to download that GenWealth's Essential Cash Flow Tools at getreadyforthefuture.com/cash flow. Our fourth blind spot on our show today is not planning for health care and long-term care expenses. I thought Burt made a great point when he was talking about your season of life. You notice inflation in different ways. The average inflation rate over the last 20 years has just been a little north of 2%, but that's on goods and services, right? If you talk about health care, if you talk about long-term care, it's not 2%. It is much higher than that. And listen to this stat. The average 65-year-old couple will spend $285,000 on healthcare expenses throughout their retirement years, according to Fidelity.
Yeah, that's an incredible number, and you've got to have some backstop. Now, some people have enough money that they can just handle those expenses without any problem, and they would do what we call, Janet, self-insure.
Yeah.
They're not relying on an insurance company, and there are people that don't have hardly any money, and they're going to rely on the state. But for those people that are in between, and that is most of the people listening to this show, you're going to have to deal with the healthcare issue one way or the other. And in most cases, you need a backup, some sort of backstop. And that's where long-term care insurance comes into play.
And we would really encourage you to just be intentional about this decision. Some of you are going to look at it and decide that you don't want to do it. That's fine. You've been intentional to seek the information and to make a well-informed decision. That's all you need to do on it. Guys, I'll tell you a quick story on this week. Troy and I had the opportunity to meet with some long-term clients, and they were asking us about some insurance that they had in place before they came here, and they just kept it when they came. It kind of made sense to do that, but it was a cash value type of policy, and they're at a point where when you look at life insurance, they're self-insured. They don't need that insurance anymore, and they're continuing to pay those premiums every month, and the husband was like, I mean, talk me out of this if you need to, but I'm kind of done with this. And I went, okay, you're right on the life insurance side, but do you know that cash value that you've built up can help you pay for your long-term care coverage?
That's right.
And so if you're sitting out there and maybe you're at that same stage of life, maybe you have a life insurance policy that you're questioning whether you need it anymore. Let me say, first of all, don't cancel it until you talk to an advisor, because you don't know what you don't know. Let us help you make that decision intentionally. But there is a possibility that you could utilize that to address your long-term care expenses, and in some cases not have to pay anything else moving forward.
Yeah, those are great conversations to have if you're at that stage of life, but have the conversation.
Yes.
Make an informed decision instead of doing the ostrich thing and sticking your head in the sand and hoping it all goes away. That is a self-perpetuating blind spot.
That's right.
It really is.
Long-term care is such a real blind spot. When I think about the practical application here, meeting with many clients who are close to retirement and really never considered this. And if they are very close to retirement, it may be too late, because health-wise, they may not even be able to be approved for a long-term care policy. So you don't want to do it too early, but you certainly don't want to do it too late if it's something that you need to consider and talk to an advisor about. All right, so our fifth and final blind spot on today's show, assuming your future finances will get easier. And really where this kind of is talking about is if you're not saving or not saving enough for retirement, or it's not a priority in early in your life or even in the middle of your life while you're raising children, the assumption that I'll start saving and investing when I get a raise or when my bonus comes through, when, somewhere out there, you keep putting it off. And maybe it will, maybe it won't. You know, I think about when my kids are out of the house, I do think I'll have more cash flow. And I do think it's called a catch-up contribution after age 50 for a reason. I think there's an opportunity to add to your savings, to invest more. But if you haven't started for some reason, that could get you behind in a hurry.
We talked about the time value of money on one of our previous shows, and how just getting started very quickly early in your life can make a big difference. But it is important, if you're approaching retirement and you're short, to use those catch-up provisions and things of that nature to try to finish strong if you were not able to start strong. And that's why we say, look, wherever you are in this journey, you are where you are, and we have to work with what you have. We're going to work with you to try to make the most of that going forward by doing a plan.
And I'll pick up on the wherever you are thought. Again, the blind spot is assuming that your future finances will get easier. I want you to think about where you are right now, regardless of your age. If you're 35, let's say, then is it really easier than when you were 25, or is it just different? it's probably just different. And the same is going to be true of the next 10 years and the next 10 and the next 10. So start where you are. Don't wait for it to get easier. Make a difference so your retirement will be easier later.
So as we get ready to wrap up, I'm actually going to be jumping the shark a little bit here. We haven't gotten our closing bell yet, but we are in the last few minutes of our broadcast, so we want to kind of hit our final thoughts. And you think about a blind spot and what that really is in your when you're on the highway, when you're on the interstate. I drive a pickup, and I do have a very significant blind spot. As we were talking about these things, I was thinking about, well, what do I do? Every time I'm ready to change lanes in the interstate, I actually turn my head. I don't rely on that mirror on the side of my vehicle to assume that I've got everything covered. I have to kind of crack my head around and make sure to look in my blind spot to make sure that I don't pull out in front of a car. Blind spots can cause you to wreck your car. Don't let them wreck your retirement. What you don't know about money can hurt you. And we talked about them today on the show to recap, focusing on the small things and ignoring the big ones. Ignoring inflation, the gap between perceived and actual spending, not planning for health care and long-term care, and assuming your finances will get easier in the future. It's called a blind spot because you can't see it. And my final thought is, you have one, you may not know it.
And my final thought on that would be that, you need some help maybe seeing that blind spot. And that's really what a financial plan is. It is not a terribly hard process to go through financial planning. You gather a few documents, you come in, you sit down, you have a conversation. At GenWealth, you'll have a conversation with a couple of advisors that will be dedicated to you to be sure that they see you through whatever it is that you're dealing with here. And so it is a very easy process. We're making it even easier if you call today, 501-653-7355, and ask for our special on our financial planning fee. We're going to discount our financial planning fee 50% to try to help you avoid some of those blind spots. So my final thought is, give us a call. Don't be blind about it. Go ahead and make that call and get in on the special that we have today.
Guys, I think my final thought would really run parallel to what John is talking about. We've talked on here before about my dad's vision being so bad. He was blind in one eye and colorblind in the other. He didn't have depth perception, and yet he drove, tractors and things like that. But there were certain situations where he could not do what he needed to do without somebody assisting him, because he had a true blind spot that he just couldn't overcome by himself. And I think it's important for us to know we all have blind spots financially. So if you're not working with somebody, how do you know what your blind spot is? So give us a call, 501-653-7355. We'll help you find your blind spot and help you figure out how to overcome that.
Our thanks again to Burt White for joining us. For John Shrewsbury and Janet Walker, this is Scott Inman saying so long. Thanks for listening. We'll talk to you again next week.
The GenWealth Financial Team is available to you 24/7 at info@getreadyforthefuture.com or call our offices at 501-653-7355. You should personally consult a financial advisor before making any investment, and no strategy can assure success. GenWealth Financial Advisors is an Arkansas-registered investment advisor with securities offered through LPL Financial, member FINRA SIPC.